Guys, hi, how are you? Today we are here with Santiago and with Eddie. We're part of my team, and we're gonna go over Opendoor. Opendoor is interesting because it's one of the company, Chamat Spark, and all of you recently, Chamat is bringing a lot of hype towards his company, is try to be loved by the communities and things. And Opendoor, it's a real estate disruptor, or at least it looks like it. It's a company that will allow you to list your own property and do it automatically, doing through the portal without going through all the hassle of agents coming in and out from your house. And but he has a lot of issues as well. We have some competitors like Redfin and Zillow. And to me, it sounds interesting. It's a huge TAM. One of the things that we're going to look now in the video, and they're going to tell you more, is eventually understanding if they do have or not have, or if it's important to have at this stage a moat, right? The moat is always important. But when the TAM is so huge and the opportunity of growth is so high at the beginning, it doesn't really matter, the moat. So that's something that we're going to eventually also talk in the future in our company, in our videos, right? Because moat is one of the things that our company focus most, and indeed we are called moat investing. But there's a certain stage of company life when you have such a huge TAM, then eventually you can probably, for a few months, at least also if you are trying to buy on the hype, not look too much into the moat. For the long term, the moat will always pay back, because a company without a moat would have issue, and then we'll understand why. But anyway, I'm going to pass the word to Eddie, which studied deeply Opendoor, and then to Santiago, who's going to go through the valuations and why he thinks Opendoor is a great investment. Please don't forget to click a like and to subscribe to our channel. Eddie, please go ahead.
Hi guys, it's always a pleasure to be here with you. And as Antonio said, we are now covering Opendoor. Opendoor is an online San Francisco-based real estate platform that aims to be a one digital shop to buy, sell, and finance real estate assets. So the core business consists of buying houses, prepare them, and then releasing them for sale. So you can submit your house address and property information, make a sort of video walkthrough from your phone, and show your home around, and then receive a fair price in a matter of days. For the price estimation, they rely on artificial intelligence-driven technology that takes several elements into consideration, and like the fluctuations in price in the area, the selling history of the property and properties surrounding it, and also the video that you take when submitting it to the platform. They are changing the whole complicated process of selling a house to a much more comfortable, easy, quick, and online operation. So while the traditional way of selling properties is complex, uncertain, slow, and human intensive, what means offline, Opendoor aims to make it simple, certain, fast, safe, and online, basically. So we made an example. We actually made an example with a property that was listed on internet by an agent. The house was listed for $400,000. So the house seems to be in excellent shape. So it will probably, just sell around that price. And the user submits the property. So we can say here, they receive a preliminary offer. Then what they do is that the algorithm of Opendoor will give an estimated price for the house. Then the user will schedule a video walkthrough of the property, and Opendoor will make a final offer. That's it. In a matter of days, you will have a quick estimation and price for your house. For this example, this was a real one. As I said, the owner of the house can easily get $350,000 for his house. If you take out the expenses, the commission and everything, it can really be a good offer. You will avoid a lot of problems, and you will sell your house in a matter of 2 or 3 days. The real estate market is currently one of the hugest undisrupted markets in the world. Just the USA is a $1.6 trillion market. So the process of buying and selling houses hasn't changed much in the past decades. So this is a market that is, willing to be disrupted, as we say. The problem is there are some platforms out there where agents and owners list their properties, and you might have heard of Zillow, Trulia, and others. and they are now getting into this space of disrupting the real estate market by selling and basically flipping the houses online. And for example, we have the Zillow owned houses that they sell in a matter of days too, and they take roughly a 6-7% commission. And then you have OfferPad, you have NASDAQ, and you have also others that are in the space. It is important to mention that Opendoor is also making some agreements with some of these companies, and in the future we can see other alliances with Opendoor and listing companies, listing platforms. That will be really interesting. They are now doing it with Realtor.com, and they are also getting some other companies into it. And now Opendoor is, as we say, leading the race. When there are no barriers to entry on the market size and the company does not enjoy a particular MOAT, we are at risk of going into a very competitive space, as Antonio said. However, so far, Opendoor is leading this rate. They are selling roughly 4 times more houses than the second competitor in 2019, that it was Zillow. And then you can spot also some interesting names in their management, and they have experience from both sides, right? Technology and also the real estate industry. They have real great conversion rate is about 34% of their clients, of ones that register their houses with them. 34% of them finally sell their houses through Opendoor. It's a huge rate for this kind of business. Now we can see also their current market share, and they are aiming to go to this one. So they are trying to get a 4% of the whole market in the whole real estate market in the US. We are now going to pass it on to Santiago, who will tell us a little bit more of this.
Yes, good evening, and thank you for inviting me. Well, as you said, I mean, this is a very interesting company, and the reason why we are looking at Opendoor is that basically it is growing faster than its competitor, and this is extremely important because they are set to build up a moat faster than all other companies. We are moat investing. We are moat hunters. We look for company who can rely at a certain stage on a competitive advantage, which would make them more profitable than its competitors. And this is what, in our view, Opendoor is set to be. So a company which is disrupting, let's say, a very consolidated market. So real estate market is a very consolidated one, which has basically relied on the same rules for decades. And they are trying to innovate the process of selling, buying, financing, and all other ancillary services which relates to the, let's say, to the real estate market. So now, if we look at the margins, basically. What these margins are telling us, basically now clearly the company is not profitable, but it is not important at the moment. It is important that they can grow faster than their competitors. 2020 revenues were 2.5 billion, and they're expected to go up to 3.5 billion in 2021 and probably to reach almost 10 billion in 2023. By that time, they should be profitable. We should wait for 3 years to see this company reaching a positive EBITDA margin. Well, probably it might happen a bit faster if they scale up faster than expected, or it might delay. Clearly, this is the risk applied in investing in such a company. So what are you buying? You are buying growth. And for the time being, this is what they are delivering. They are delivering growth. If we go ahead into the presentation, we can see, yes, to the valuation approach, we basically can see where's the value proposition here. The value proposition here is in the company growing at almost 60% growth between 2020 and 2023. And this is something they can basically achieve because it's not only selling and buying, but it's also offering what ancillary services like insurance, refurbishing, and all other services. From 2023 onward, they are expected to slow the pace of growth, but anyway, they should continue growing at some 30% compound annual growth rate. This is a company which, if everything goes the right way, they're expected to be a 40 billion revenues company in 7 years time frame with almost 7 billion EBITDA. We are projecting 18% EBITDA margin, which is our projection because we can't rely neither on consensus nor on company guidance, which they look at the short term. The EBITDA is even lower as compared to other, let's say, disruptive company in the real estate, which are targeting a 25% EBITDA margin. And we have also assumed a lower EBITDA to free cash flow to equity conversion for this company. Why? Because basically this company is buying and selling properties, and the process of buying and selling means having this the property in the inventory and then resell it, which carries on a risk which is higher as compared to other disruptive company which just offer services. So this is a riskier business model. We have factored also this increased risk in the discount rate. So it's not 10% as we have used for other real estate disruptive company. We have relied on a 13%, so we have an additional risk premium of 3%. And if we plug in all this figure, basically we come out with a valuation in the region of $36-37 per share. We believe this valuation range, our valuation range goes from 30 to 45 per share, and we believe it is sustainable. We assume basically a discount rate between 12 and 14, and a perpetual growth rate between 2.6 and 3.4. This is sustainable also if we look at the price to sales ratio, which if we take our central case valuation, $36 per share, implies 3.3 price to sales 2022, which is low. If we look at the other companies where value driver is growth, investors are willing to pay even 2 digits price to sale ratio. So this company is trading at a relative low price sales, we believe. We have also relied on sensitivity to see how the value is affected by the value drivers. So in our model, we have 5 value drivers, which are very simple to understand. One is the growth in revenues. The other one is the EBITDA margin, the free cash flow conversion. So to which extent the EBITDA is converted into free cash flow to equity, the discount rate, and the perpetual growth rate. Clearly, the most sensitive value driver is the compound annual growth rate in revenues, which confirms that this is a story of growth. We can see that for each 1% increase in the compound annual growth rate from 2020 to 2028, we have a $2 increase in our target price. So this company is extremely sensitive to the compound annual growth rate. If we look at the free cash flow conversion, we see that each 10% increase in free cash flow conversion, we have a 6% increase in our target price. So this confirms to us that basically they have to continue scaling up as fast as possible. And one of the major risks we see is that probably the shareholder base might be diluted in the coming future as they might look for new resources to invest in growth. But as long as these resources are used to scale up faster than expected, we believe it's fine because they will deliver value at the end of the day. So just to end up, we believe this is with disruptive real estate company or the company which is expected to disrupt the real estate market. This is probably the most interesting value proposition, and we remain extremely positive for the time being, as long as they continue to deliver growth. So I'll pass the word to Antonio or to Hedy if you want to add something, or if you have any question.
Yeah, you mentioned something really important, and Santiago, and I think there is great potential on the extra services side. So basically, it will be easier to handle everything with them, from buying or selling the property to the moving services, home loans, warranty, insurance, reparations, everything. So they have done a great job with the title and escrow service, and I think they will be able to replicate that to the other services. So the revenue side, the extra revenues will come in. Absolutely.
Yeah, no, I agree. I mean, you touched a very important point, because compared to other, let's say, disrupting real estate company, they don't have to get the clients from somebody else. They can rely on their own clients, and they can offer a vast range of services, which is completely different. Because when you take the client from somebody else, you get the commission, and then you try to sell other services to that client. In this case, their strategy is piggyback on their own clients. So once you sell, probably you need to relocate. So you need to buy, you need to finance your property, you need to refurbish your property, you need an insurance company, and these are all services they are set to offer.
Great. So guys, I think the time is up, but we're going to probably discuss further and eventually competition with other companies similar. For example, those services can be offered also by Porsche, and it's one of our company, eventually Zillow, and how Zillow is going to react to this and what is the difference between Open and Zillow. We're going to discuss that in our podcast. So for now, thank you and see you later.